What's up, everybody? It's Guys here. So, between rising interest rates, persistent inflation, an impending recession, and a war in the Ukraine, it's no surprise that the market has been absolutely brutal so far this year, with the S&P 500 down more than 20% from its all-time high just 3 months ago. Even though every single day feels like a game of musical chairs with people scrambling for the exits, this is one of those times where if you keep your head, you could be in a position to come out ahead. That's why today I want to walk you through exactly how I'm mastering the market, what I'm buying. Why I believe now could be one of the best opportunities in a generation to get ahead, and how you can make the most of it too. Although before we start, as usual, if you appreciate videos like this, all I ask for in return is that you take 2 seconds of your time to smash the like button or subscribe. Doing that helps me out tremendously, and as a thank you for doing that, here's a picture of a baby gecko. So thank you guys so much. Alright, so to start, the very first thing that I think you should consider is that the market is forward-thinking. In other words, stock prices tend to reflect the future outlook of a company rather than the present. And in this case, the next 6 to 12 months are looking pretty bleak, with consumers pulling back on spending, businesses cutting back on hiring, and some companies even beginning to lay off employees. But while that might seem really scary, keep in mind that the price you pay today is based on the expectation of what a company is going to earn tomorrow. So if prices have already declined significantly because of weaker future earnings, then that means we could be in a position to see a quick rebound once things begin to normalize again. In fact, Bank of America believes that the worst of the selling could be behind us, with a 90% chance that we see a 20% decline by the end of July, which would technically put us in a phase known as a bear market. JP Morgan also believes that we have a 60% chance of seeing a bear market bottom in the next month, which could signal a great buying opportunity for long-term investors. Of course, they're not always right, but they do have a solid track record, so it might be worth keeping an eye on just in case. Second, we have to talk about the Federal Reserve because their policies have a direct impact on the entire market. See, up until recently, the Fed was buying corporate bonds and mortgage-backed securities as a way to stimulate lending and get the economy back on track after the pandemic. They were also keeping interest rates near zero to encourage borrowing and spending. However, with inflation at a 40-year high, the Fed is now in a mission to fight rising prices by slowing the economy down. As of today, they've begun to sell off their assets and raise interest rates to levels not seen since 2018. Their goal is to reduce demand and bring down prices without causing a catastrophic collapse. It's a tightrope that they have to walk carefully, or else we could see higher unemployment, lower profits, and a longer-lasting recession. Now, third, even though this might be a little bit scary, I personally try to remind myself that the market goes down every single year, and on average, the best days occur during a bear market. In fact, according to a study by the Stock Traders Almanac, you would have missed out on 38% of the market's best trading days over the last 20 years if you just kept cash on the sidelines. On top of that, since 1930, there have only been 20 instances where the market declined more than 20%, and every single one of them recovered. Finally, fourth, it's important to remember that markets are cyclical, and what goes up must eventually come down. If a company is growing at 100% per year, it's unlikely that they'll be able to sustain that throughout the entirety of their business. And usually, the higher the peak, the harder the decline. For example, Tesla has increased nearly 18,000% throughout the last 20 years. Although when you look at it on a month-by-month basis, you'll see that they've had their fair share of drawdowns along the way. The point here is that it's perfectly normal to see pullbacks like this, and statistically, it's actually a good sign that a recovery is coming soon. So in terms of what I'm doing about all of this, here's the reality. When it comes to my day trading, I'm taking a wait-and-see approach. To be honest, I don't have a strong conviction either way, and that makes me feel a little uneasy. So I'm holding a lot more cash than usual. The rest is primarily made up of index funds and ETFs that I'll continue to buy into on a regular basis, regardless of what happens. I'm also continuing to invest in real estate and businesses as usual because I don't want to let emotions get in the way of my long-term goals. And finally, I'm spending the exact same way that I normally would. To be honest, I don't think there's any reason to panic, pull back, or try to time the market because it's impossible to know what's going to happen in the short term. Instead, I'm sticking with the strategy that got me to this point, and I'm betting on the idea that if I hold on for the long term, then everything will work itself out in the end. So with that said, you guys, thank you so much for watching. Also, make sure to add me on social media and to my second channel. I post there every single day. I'm not posting here. So if you want to see a brand new video from me every single day, make sure to add yourself to that. Thank you so much for watching, and until next time.